Hello, I'm Jeff Brown for Knowledge at Wharton, and today, once again, we have Wharton Finance Professor Jeremy Siegel with us for a few minutes. And thank you again for being with us.
Happy to be here, Jeff.
Well, it's late January, and everybody's getting their statements, year-end statements from 2013, and seeing the stupendous gains they made in the stock market, getting ready to pay taxes on them. And now all of a sudden we seem to be falling off a cliff. The S&P 500 is down about 3% year to date after being up 32% last year. What is going on?
Well, it shows you how used to gains we are. After up 32%, we call down 3% off a cliff. I regard it as a little bump. No bull market goes up in a straight line. I mean, obviously. I mean, we haven't had a correction which is defined as a 10% decline in the market for at least 2 years, which is pretty remarkable. Now, I don't think this current reaction is going to move that far, but again, bull markets. In fact, many technicians say it's healthy for a bull market to have this correction because it sort of blows off the excess bullishness that sometimes accompanies rising prices.
Well, what has triggered this now? Why now, not a month ago or a month from now?
Well, I mean, ostensibly it was the emerging markets. People are saying, again, the tapering. The truth is, of course, the tapering was announced in December. So if markets are at least even partially efficient, why is it reacting 4 weeks later to something that we knew in December? We had a very disappointing labor market report. Earnings are coming in so-so. Some actually, the percentage that are beating earnings, at least at this point, is actually a little bit more than average, but the beat is a little less, and some of the forward guidance isn't too good. That's been a little disappointing because we know that the second half of 2013 had better economic growth than the first half. So many of us thought that maybe the fourth quarter would surprise us more on the upside, but it's still early. Let's wait until we get more data on that.
So in some ways, it just looks like people are looking for an excuse to sell and take some of those immense profits from last year.
People talked about the bullishness in the market. One of the indicators that I look at that monitors market sentiment is called Investors Intelligence, which for 50 years has been looking at bulls and bears. And indeed, my indices reached 20-year highs. Just recently, right after January, when everyone's saying, "Hey, there's nothing in the way of this bull market." And you got to get a little worried when we get to that particular point because historically, bull markets have climbed the wall of worry. There's always, I'm worried about this, I'm worried about this. That's one reason I'm out of the market. I don't think this bull market is over. I still think there's room to go.
One of the things I'm curious about is that we're beginning the tax season, and a lot of people, of course, are sitting on big gains from last year. I'm curious, is raising cash to pay your taxes a factor in this?
Well, only if they sold, remember.
Yes.
If they didn't sell, one of the nice things about capital gains is you can let them ride until you want to. So it has to do with how much of that was sold. I don't think so. Taxes are really due in April. Of course, if you pay quarterly, you had to come up already with that January payment. So I think it's more of just the fact that it got a little bit overbought, a little bit over-optimistic, and they're using the bump of the problems in Argentina, the problems in Venezuela, Turkey, I think as more of an excuse than anything to take some profits.
When you open the hood and look inside at things like the PE ratio and other gauges that you like, what do you see?
Okay, what I see is that our traditional gauge, which is using the S&P 500 earnings against its level, is very close to its historical average, very close to the average of the post-World War II period, around 16 and a half. Yes, on the basis of 2013 earnings, we're at around 17 right now, although it's come down a little bit in terms of that. It's a little bit above, but it's been my thesis for more than a year now that this market is going to go above its historical mean. And the reason for that is the low interest rates. With so little competition from other asset classes, in my opinion, that would lead to a somewhat higher valuation. So to me, I think this bull market is going to 18 to 19 times earnings, which is another probably 10, 12% in prices.
Higher than they are today?
Higher than they are today, yes.
By when? The end of the year?
Well, I say that. Of course, it's a fool whoever predicts short run in the market. Again, we could go even much higher. I remember on one program, people say, well, I said it could go to 20,000. Everyone said, oh, Dr. Siegel, are you predicting 20,000? No, that would be overpriced unless we have gangbusters economy in 2014 and 15. But we all know that, stocks are often in a range of 20-25% of fair value, and sometimes they even get outside of that range. So I think fair value on the Dow is something like 18,000, 18,500. But obviously, again, it doesn't move in a straight line to those levels.
You mentioned tapering, and of course this debate over tapering has been going on since May, I believe. Yeah. When is it going to start?
Yeah, when Bernanke first
Are we placing our bets now or later? Is it built into the market? So on and so forth. But now it has begun, and I'm wondering what effect you see there. The argument was that all of this money from the Fed is propping up stocks. Take it away, stocks will fall.
I have maintained that the biggest myth of the market in 2013 was that the bull market, the 30% plus gain, was all due to Fed pumping in money into the economy, QE in other words. I said, hey guys, on the basis of earnings alone and valuation relative to alternatives, I can completely attribute this rise in prices. I don't need QE. I think QE it certainly doesn't hurt. I'm not going to say it hurts, but I think it's way too overemphasized its contribution to the great bull market that we've seen over the last 2 years. It really is the fading of the fears of another collapse that 2008, 2009 brought on. As the years go on, we see these risk premiums go down. Oh, there isn't going to be a currency collapse, this municipal collapse, a commercial mortgage collapse. All of a sudden people are saying, the economy may not be great, but I don't have those primal fears that so dominated the market 2009, 10, and 11.
And the Fed's plan to reduce its bond buying program is a pretty slow process, and then it will be well done before they get around to actually raising short-term interest rates. Are you comfortable with the pace at which these things are planned?
Yeah, I am, and even that pace isn't in stone. I expect them to continue on the $10 billion tapering at this week's meeting, despite the bad employment report that we had. However, let me say, if the markets go down further and we get some further poor data, surprisingly low data, I would say that there's a very good chance at the March meeting, now that is if this occurs, for them to halt the tapering. And I don't expect that to happen. I think we're going to see a reacceleration of the recovery. But again, no one should think that this pace is in stone. It isn't. It can respond any way to what actually happens in the economy.
And we're just days away from the handoff from Ben Bernanke to Janet Yellen. Is that a significant event? It is for them, obviously, but does it matter to the markets?
Well, I think the markets have now reconciled themselves. Certainly they're factoring that in. I think Janet Yellen is very competent. I think she is a very, very good choice. I do think she's on the dovish side. I think there's no question that push comes to shove. But she's also a good listener, and she's a very smart woman. And she's not and she knows that the Fed has an inflation target, and it's not going to violate that inflation target by any significant amount. So again, she is only, just like Bernanke and Greenspan before him, they are only one vote of 12 on the Open Market Committee, and so there's no veto power. Certainly, they hold sway. Their argument and their position is certainly important, but I don't think the bank presidents, who have had no qualms about speaking out when they are concerned about inflation or overstimulus, they will certainly have their voices felt if they think that Yellen is moving too much to the dovish side.
How does the economy look to you? Is it getting stronger, as it seems to be?
I still think so, despite the fact that we, again had that poor employment report for the last month in December. I think we have a chance for 3.5% plus even in GDP growth for 2014. Again, the better markets, the better. I think finally the balance sheets of the consumers, with the rise of the housing market, the rise of the stock market, has now pretty much repaired itself. And that should give a boost to consumer confidence that could also boost business capital spending, which has been also very, very sluggish. And with housing moving up to, I think, over 1 million units at an annualized rate on a monthly basis, I think that has the capability of giving us a 3.5% or plus economy. Now, again, that certainly may not happen, and I have been over-optimistic on economic growth over the last 2 years, but I think the stars are better aligned for such an acceleration in this year.
One of the elements of consumer confidence, of course, is jobs, and whether you think you're going to lose your job or your chances of getting one if you have. You think the job situation is going to improve?
Well, I think the fear of losing your job has been gone down for 5 years. We've seen the unemployment go down from 10% down to 6.7%. So, and we have seen net hiring by firms. It's always going to be present, and there's always firms that are going to be cutting back. But 200,000 jobs, and in the private sector, actually, the job growth that we got over the last 12 months, even with the poor December report, has been fully as much as we had in 2003, 4, 5, and 6 before the crisis occurred. It's a little bit less than we had in the booming 2000 period, 1990s to 2000 period. But still, the growth has been decent. So I think the labor market's going to be fine.
And that's the private market. One of the problems is government cutbacks have been hurting these overall numbers.
Oh, there's
right?
No question about it. I mean, this is the first time really ever that we've had a sustained actual slightly negative on average balance of government numbers. Government was always adding 30 and 40. If it wasn't the federal, it was the state and local boosting it. I mean, Bernanke has made that in some of his speeches, again, toward the end of his term, saying this recovery, given the contraction of government, has actually not been that bad. And so if we, assume that government's contraction will slow, we're not going to have the sequestering that we had before, not quite as severe, the movement towards that. I mean, it's going to stay in place, but it's that contraction is going to be gone. That would neutralize the government as being a decidedly negative factor and let the private sector carry the economy forward.
Unemployment upwards of 6% is the kind of thing that we used to look at with absolute horror, and I suppose many still do. But if you break down the number, it's not that bad among those with college degrees. It's really people with less than college and less than high school that are making up
as
a
it always
bulk of
has
that.
been.
It's always the truth.
That's that is always been the case. The better educated, the much lower the unemployment rate is. The Fed now regards about 5.5% to be 5.3, 5.5 to be the long-run unemployment rate. Now, if we were talking in the 60s, we'd probably say it's 3.5 to 4, but various factors have raised that over time. So I say 5.5. So at 6, 7, we're between 1 and 1.5 percentage points above what the Fed thinks is the long-term unemployment rate.
Many of the people who have less education and lost their jobs during the crisis may have lost jobs sooner that they would have lost over the years anyway as things change. I'm just, I guess, really concerned. Are they ever going to get those jobs back?
That the job market is changing. It's changing even for some trained people with the rise of technology being able to substitute for it. The low-skill jobs I don't think are coming back. I mean, there's just too many people around the world, and with technology and communication being so easy to bring that to the fore, that they can take over those low-skilled jobs and produce the goods and ship them, or even do the services by remote telephone centers that we have in the less developed countries. All sorts of services are going to be outsourced. So you have to find your niche about what kind. There's always gaps in services. There's always areas where the people who are gaining from the technology want to spend. I mean, there's been a restaurant boom. Younger people are enjoying going out. I mean, these are the type of service areas that are expanding, and there will be others. So again, it's a dynamic economy. But the old factory job, even with manufacturing, stabilizing, the old manual labor job, except maybe in the healthcare area where people might have to have some personal assistance, is probably not coming back.
Let's switch for a second and look at the bond market. And of course, when interest rates go up, people don't want those older bonds that pay less, and so you can lose money on your bonds. Is that something we need to worry about today? And how does that work into an investor's thinking about asset allocation in a portfolio?
Well, think of what happened last year. I mean, we had a bad bond market, rising interest rates, and a really good stock market. Now, I think this stock market will be good this year, not as good as last year, but that was certainly spectacular. I think we can see a 10 to 15% return at the end of this year for stocks. I still think you're at big risk with bonds, even though this first 2 or 3 weeks have been great for bonds. Bounced back from just over 3% on the 10-year down to 2.7 with this, little bit of a, pullback on risk, the emerging market crisis, which I think stimulated a little bit of, oh my God, I remember 1997. Maybe you remember, Jeff, that the Asian crisis, remember that, really whacked the market. And I think a few of the older traders, and those with a little bit more gray hair like we have, said, oh, just a minute, I hope this isn't the start of that. And I think that's causing a little bit of that anxiety we're seeing in the market today.
So ending with something practical, the investor who has just finished 2013 with big gains in his stock portion of his portfolio and is thinking now about reallocating, rebalancing, as they say, should they be looking to get back to their original goal, or should they be saying the bond market is a little too scary, maybe I won't allocate as much to bonds? What do you do?
I still don't think bonds are going to be offering really positive return. Long-term bonds, certainly you can get the interest rate, but at interest rates of 3%, the price falls 3%, and you've wiped that out. I still think it's going to be negative returns for bonds. We know it's zero for money markets. Not much change going to be this year, maybe 2015 a little more, but not this year. And your alternatives still, and if you want income, as we've been saying for so long, there are very good dividend-paying stocks that are yielding 3-4%. There are many dividend mutual funds, exchange-traded funds, et cetera, that specialize in that. And you're going to get that growth because dividends are growing 10 to 12 to 14% a year. One of the strongest dividend growths we've actually seen, Jeff, and in terms of increases. And most analysts that I talk to expect it to continue in 2014.
So you're basically optimistic about the economy and basically optimistic about the stock market, not too keen on bonds.
Yeah,
that summarizes it.
Yeah, and that was pretty much 2013. But again, always reminding, and no bull market goes up in a straight line. You have to get through these corrections that will always be part of the stock market.
All right. Well, we'll come back in a few weeks or a month or so and see what's happening then. Thank you very much.
Thank you, Jeff.